All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Um, Real quick here, I noticed there was some talk here about tapering. One of you asked what my thoughts are overall with taper. I'm not going to spend a lot of time on it, but I don't believe we see taper. Essentially, the Fed is getting what they want. They know that if they start to taper and only taper 10 billion or something small, that the market will price in a full taper, and they can't afford for that to happen. So what do? They talk taper. They keep talking taper. They keep Bernanke from talking taper, and they let all the other people like Lockhart and everybody else talk taper and throw out speculation of taper. So what does the market do? It prices in a partial taper, which is what they really want. They want a partial taper. The economic data has been good enough to warrant a partial taper, not good enough to warrant a full taper. How do they get partial taper effect? Well, they talk about taper, then you get a partial effect. If they actually start the taper, they will get a full taper effect, which they think will have negative implications on the market. Also, with tapering, they know that if they taper and then have to come back and add more juice to the markets, that they won't have any credibility at that point. QE1 was one thing, QE2 is another thing, QE3 has been also infinity, kind of QE infinity, and they start to pull that off and have to go back. It won't be like Q1 and Q2 ending and going back to more quantitative easing. Also, we have the big budget standoff here coming January, February. And the Fed in their minutes admitted that the reason they didn't taper in September was because of the budget standoff that was looming. And they knew it wasn't going to be resolved easily. They knew it could weigh on the economy. And this budget standoff that we have coming up here will only promises to be greater than what we experienced just recently. And so the Fed, their most nimble position is to stand pat and to not make any changes. And so while they may talk taper and change their wording to actually see action and actually see taper happen, I think the odds of that are almost zero, at least until we get into March or April next year. Anyway, that's just my opinion for whatever that's worth there. All right, yeah, SLB Max. Let me pull it up here, Schlumberger. And Schlumberger is one of the best domestic drillers that's out there. They have a lot of good things going on. They continue to grow. They continue to be very profitable. A lot of the moves in these energy names are very reminiscent of 2008 when we just saw them continue and they just marched on higher and hit all these new highs. Schlumberger isn't tremendously overvalued here. To see it correct a little bit wouldn't be surprising, but it'd be something I'd rather look to be a buyer of on a dip than to short up at the top. From a technical standpoint, yeah, Max, like you said, there's some weakness in the indicators. You have some bearish divergences overall. You have some breakdowns in a variety of indicators here. But bottom line is it's pretty much consolidating, right? 92 to 94 has been the consolidation area. Does it threaten to trigger a trend rider bear signal here today? Absolutely, it does. Okay, absolutely it does. But just because it's a trend rider bear, in this market, we've seen a lot of stocks that trigger trend rider bears like Dish yesterday actually go the other way. And so, with Schlumberger, oil under 100, yes, that's going to take some steam out of their stock. And the same thing for Halliburton, and both are showing bearish signs from divergences within indicators, from various candles, and showing signs of wanting to break down. Will they? I suspect they do, but it's not something I'd bet a ton of money on with them. Okay. All righty. I want to talk here about Dow theory. And I'm talking about this because of several requests here to look at long-term picture of the market. in terms of IRAs, in terms of long-term investments. Now, I have a lot of experience as a fund manager, and I've done that for many years. And but my passion is trading the markets. It's not in the long term buy and hold type mentality and in the fund managing world. Okay. So I just, as a caveat here, that I need to explain that I'm not an investment advisor or retirement planner or anything like this or like that. But I can show you what I look at from a long-term standpoint and what the market itself looks at. So I'm going to talk a little bit about Dow theory here today, because it's a good long-term strategy as far as understanding simple allocations in your portfolio. And bottom line, my father-in-law, he constantly asks me, Jeff, I have my 401k. What should I put it in? Small caps, large caps, or mid caps? And basically, when Dow theory is bullish, I tell him put it in small caps. When Dow theory turns bearish, I tell him to put it in large caps. And that's essentially how I manage that. I'm not gonna, give him advice on a day-to-day basis, but from a longer-term standpoint, kind of a low stress. So let me talk about Dow theory here today, and I'll talk about what the assumptions are, how to read it, but then I'll also talk about some of the holes with it. Now, Charles Dow is credited for Dow theory, and we have the Dow Jones Industrial Average, right? And Charles Dow was credited with a lot of some of the early technical theories with the market. And basically, Charles Dow, in his writings, though he never coined the term Dow theory, talked about, hey, when the industrials are strong, essentially the factories, think about this 100 years ago. Well, this was the days of Rockefeller, of Carnegie Mellon. These were the days of Cornelius Vanderbilt, some of the big tycoons. And they basically were after the industrials, the factories, right, with Carnegie Mellon and Rockefeller. And then you had the rails or the transports, okay, which was there were a lot of battles over, and some of those stories are quite fun. But Charles Dow said, look, if the industrials are doing well, the factories, and they're shipping their products and the rails are doing well, that tells you something about the economy. The economy is probably doing well, and therefore stocks should rise. Then he looks and he says, all right, well, if the factories, the industrials aren't doing real well, and the rails aren't doing real well, the economy is not doing real well. So therefore, stocks are likely to fall. Okay. Now, there were two others that kind of took Dow's writings. There was a guy named Nelson and a guy named Hamilton. In fact, Dow theory, the term was first coined by Nelson in a book that he wrote called The ABC of Stock Speculation. Okay, so it should give you some idea. Dow theory is one of the first kind of technical theories to come into the marketplace. Robert Rea in 1932 wrote a book called Dow Theory, and that's where most of what the current or modern Dow theory understanding comes from, is Robert Rea's book. And, the markets are obviously a lot different now than they were. And there are a lot of changes, but Dow theorists will argue that it still is very valid. It's still a very valid theory and still continues to work here today. When looking at Dow theory, okay, we need to keep in mind a couple things. Number one, there are some assumptions. Okay, every theory has assumptions. Okay, back in college, I studied economics, and I loved looking at economic models. Why? Because for every economic model that somebody wrote or did, you had to read a five-page list of assumptions just to get into that model. And after you read all the assumptions, you realize, well, there's no way that could ever happen because all the assumptions take variables that and fix them and make them so that you can't alter them or make it a real world scenario. Some argue that with Dow theory, but here are his assumptions. First assumption is that the theory is not perfect. Okay, and that's one of the things that all Dow theorists will recognize. Second thing is that the averages discount everything. Okay, so basically the two averages that we deal with Dow theory, okay, the Dow Jones Industrial Average and the Dow Jones Transportation Average. Okay, so basically everything is wrapped up into those and they discount everything, meaning all information is symmetric. Okay, everybody knows the same thing and prices are normalized on every given day. Number three, okay, and this may be the biggest hole in Dow theory today, but it's that the primary trend cannot be manipulated. Okay, Dow said no matter who you are, he recognized what people like Rockefeller and Carnegie Mellon were doing, or Andrew Carnegie, excuse me, were doing, and he recognized some of their actions and said, yeah, you know what? There's some manipulation going on here, but even with that manipulation, they can't manipulate the primary trend, the major bull or the major bear market. Okay, so these were the assumptions. And then basically he talked about movements. And he talks that there's a primary movement. Okay. We call these kind of bull or bear markets. Okay. Bull or bear markets. And these are, 4 to 6 years. We're talking yearly movements that last for years. Okay. And then there's a secondary movement or a retracement. Okay. So we can be in a bull market and still have some sort of retracement, some sort of negative period where stocks correct and push lower. And those can go on, even for a year and a half to see that. That can be a secondary movement. Modern Dow theorists talk about tertiary and all types of other movements, but these are the two big ones. Okay. So the important part here in understanding Dow theory is to understand the primary movements, okay? Because basically Dow theorists say, all right, you know what? We just want to recognize what the primary movement is, get on board with that and ride it. And as long as we're riding the primary movement, we don't care about the secondary movements. We know that, hey, we might buy a little expensive today, but in the long run, it'll pay off for us. Now, these primary movements, basically a bull market, he talks about them happening in 3 phases. The accumulation phase, the big move, and then the excess phase. Okay. Bear markets, bear markets, we're talking about distribution, okay, the big move, and then the despair phase. Now, Charles Dow recognized that back then, the insiders had a great advantage. The insiders were able to see things much sooner than the public. And he basically said that the primary movements begin as the insiders recognize a shift. So let's say the market's in a bear market. Well, those that own the factories, those that own the rails, they're going to start to see their business pick up well before the stock market picks up. And so they're going to actually start the bull market. Those in the know will start, and they'll be in this accumulation phase. The rest of the market will be looking and saying, wait a minute, the economy's still bad, things are still terrible. They'll all be saying we should be selling, and the market will just start to go up. then you'll get, pretty much everybody jumping on board. You'll get this big move, right? Everybody says, all right, you know what? Things are going better. Jump in. You get a major move. Then you get an excess move, kind of a blowing off of the top. Basically, everybody's looking and saying, hey, things aren't as good as what we had hoped, but stocks aren't going down. Let's buy, buy, buy. And you get this excessive move, this kind of melt up. Okay, even kind of a bubble top is what some would refer that to. And then he talks about bear markets being the opposite. You get a distribution, okay, where the insiders look at this excessive area, they start to sell. Then you get a big move where everybody says, uh-oh, what's going on? Sell, sell, sell. And then you get despair, where basically people are like, hey, you know what? My stuff's not bouncing back. Might as well take my money and go somewhere else. And you get this selling, and it drives the last phase of a bear market. Pull up a monthly chart here of the Dow, okay? And a lot of this movement here from 2007 to 2009, okay, uh, really reflected what Charles Dow was talking about. And we started to see the markets, we saw them top in 2007 and go down from October of 07 through January of 07. And this was kind of that first distribution phase. In fact, during this time, you had a lot of people not really wanting to sell, saying, no, subprime's not really that bad. Everything's fine. And you start to get, you got a lot of people just kind of saying, hey, no big deal. But the insiders were selling. Countrywide Financial, their CEO was on TV every day saying, buy my stock. And what was he doing every day behind the scenes? He was selling. Okay. Then we get a little relief rally, right? Everything with Bear Stearns, they get gobbled up by JP Morgan. So everything's fine. You get a little relief rally or a correction of that distribution. But then come the summer of 2008, you couldn't hide it anymore. Public started to be aware, hey, subprime, this is bad. You got a major distribution phase. You had Lehman Brothers crash during this time, okay? And you started to sell off here at the beginning of the summer, and it sold off into November. We got a little bit of rally in December. We came off the lows a little bit, but we had this major distribution phase. A lot of people tried to call the bottom during this time and say, you know what, we're at a long-term bottom. But what happened? Well, this is when the economic data starts to get really bad. Okay, it starts to get really bad. And so we see this final despair phase that was kind of February of 2008. Absolute despair. Markets went down over 20% during that month, and they just went down every day. Not on any new news, but it was just a despair. It was sell, sell, sell. Just there was no buying that came in there. Okay, so it sold off with very much like what Charles Dow would theorize and predict. When you look at most major bull and bear markets over the last 100 years, Dow theory has done a good job of recognizing the primary moves. This accumulation, big move, excess, or distribution, big move, and despair. So where are we at now? How do we read this? How do we see where are we at? Okay. Well, let's go back to theory number one. The primary trend cannot be manipulated. Okay. Is this theory valid? Right? We were talking quantitative easing recently. Has quantitative easing changed? Has the Fed actions changed the fact that the primary trend cannot be manipulated? Okay, many will argue that it has. Some will argue that it hasn't. Okay, some will argue that this whole melt up here in the market is completely manipulated. Okay, some will argue that it isn't. So you kind of have to ask that for yourself. But bottom line here is that Dow theory says, okay, when the industrials and the transports are hitting new highs together, the market's bullish. And when's the last time we saw them hit new highs together? Okay. Well, it was January of this year. Transports broke out into a new high, okay, here in January. And both the Dow and transports have set more new highs this year than they have in many years. Okay. So Dow theory turned bullish right back here in January of this year, after being pretty sluggish for a couple years, where you had the industrials going up, but you didn't have the transports confirming it. What would it take for Dow theory to trigger a bear move? Well, it's not going to happen anytime soon. We'll probably be talking 5, 6, 7 months at least for it to happen. Why? We'll need to see the distribution phase first. We'll need to see some selling. Then we'll need to see the industrials and the transports set some sort of new lows together. And we're nowhere near that happening. So from a Dow theory standpoint, this market remains bullish and there are no threats in the long term. The primary move is still higher. Now, some Dow theorists will argue and say, hey, this primary move's been pretty long. It may be weakening. It may be nearing a top. Okay, but many have been arguing that even since 2009 in June after the market bounced 100 points. Okay. So if you're looking from an investment, from an IRA and everything, and you're worried and you're saying, I don't want to be caught in Lehman Brothers type action and subprime action, okay, well, there's nothing here to worry about. There's nothing here to be concerned about. Okay, from a Dow theory standpoint, transports and industrials continue to go higher. They're not even threatening to break down. Okay, they're not even threatening. They continue to set new highs. So what's your allocation? Okay, small caps. Your allocation is small, mid caps, aggressive. Do you want to switch that? Okay, do you want to switch that ahead of the budget showdown? Sure, maybe. My father-in-law, we were talking about this last week. I told him, look, you're going to want to switch here in December. And does that mean the markets can't keep going up? No. But he'll still take advantage of it with his large cap allocation, but it won't be as aggressive. Okay. If we start to see the transports break below this action here in January, as well as the Dow Jones Industrial Averages breaking down here below these January points, that would be pretty much a Dow theory bear signal. Okay, that would confirm that the primary trend is reversing and ready to reverse. And we're not just in a retracement or a smallish pullback. Okay? So that's the very simple. Once a month you bring up the transportation average, you bring up the industrial average, and you say to yourself, are they setting new lows together or setting new highs together? Well, hey, even this month, both have set new highs together. Okay. Now, there's one other part of Dow theory. Okay, one other part, that's volume. And Charles Dow basically said you need volume to confirm the move. So basically, we had a Dow theory bull signal set just last week. It doesn't reverse the big one that we're on, but we had a short-term signal set. But notice how the volumes are falling. Volumes are falling off significantly. Okay. Now, why is that? Is because stocks are more expensive, so you don't have to trade as many? Is it because of derivative products? Is it because your average investor isn't doing anything and they're not in here and all it is government manipulation? We may never know all the answers to that. Okay? We may never know all the answers. But overall, from a long-term investor standpoint, the direction is still higher. And if you're looking from a long-term investing standpoint, you can't look at this as calling tops and bottoms. If you do that, you're going to miss most moves. As a trader, sure, call tops, bottoms, whatever. That's part of the fun. But as a long-term investing standpoint, running it with the Dow theory tends to be quite accurate. And sticking with that in the face of some of the normal market turmoil that can come about over the course of time has been a very profitable strategy. Okay. Yeah, Matt, it seems like a trading plan could be formulated with the weekly, monthly, daily charts, maybe 20 period, 33-cent break. Can't get a decent pullback. Yeah. One of the things is, I was a fund manager through much of this time here, through almost all of this time where the markets were collapsing and rallying back and everything else. And one of the things that we did is we used from a long-term allocation standpoint, we used these weekly charts and the 7-week moving average, and basically just said, markets trading below the 7-week moving average, we may not be able to get out of all our stocks, but we need to have more protection on. From put protection or have some other options that, hey, if the market falls, maybe we add some extra short positions, add some puts, different things like that. Uh, from a big picture standpoint, because of some of the tax implications, when you buy a stock as a fund manager, you hold it less than a year, there's some tax implications. So you tend to want to hold things for more than a year, if not longer, and take advantage of some of the dividend plays. And as things started to come back, and as we were trading above the 7 month, we would kind of use this 7 month as a simple tracking device. We knew that if we started to trade below the 7 month, there was something serious going on. It was pretty dangerous out there. Okay, it wouldn't take much of a pullback in this market to start breaking the 7 month, but overall, that's kind of how we would look at things. Right. All righty, so that's out there. Any questions, shoot them over to me, Jeff at Trader Minute. Happy to help you out there with them. Let's go take a real quick look at this market here. Let's talk Capital One. Down a few pennies, no movement. I mean, look, there's not been any volume the last 2 days. There's been no catalyst. We still have a nice little bear flag setting up. Would be great to get some sort of 50-cent gap down and see it run down, break 68. Now, are we going to get that? We may not. If we start to break above 70, we're not going to play for it anymore. Okay. Yeah, Tesoro. Some of you have jumped into Tesoro. Jay, you're selling your Tesoro. Okay, sounds good. I mean, Tesoro's a wild one. For those of you that haven't traded Tesoro before, okay, today is a prime example of what Tesoro can do. And you'll notice today it opened up and it went negative for a brief period of time. Shot all the way up, went from 49, its low here of, or excuse me, today, I apologize. Let me zoom this in. Okay, today opened negative here, down to 51, immediately shot up. Okay, went from 51 to 53. Okay, over $2 move that quickly, and then within almost an hour, dropped $1.20, rebounded, and now we've seen it kind of fading. But the market's been pretty flat through this whole time, right? These refining stocks move. They are heavy movers. They're not for the faint of heart. When you look at the daily chart on them, okay, yeah, the trends seem to be pretty good. But look at the scale here. Okay, keep in mind the average true range on this stock. If you ever want to bring that up, you can just come down here to the bottom. Here at stock charts, you put in the average true range, and this tells you on average how much does the stock move. On over the last 14 days, how much does it tend to move on a day-to-day basis? Well, $1.75. So you're trading options there. You go buy $1 option on Tesoro. When you're talking about the stock moving $1.75 on any given day, it's a lot of volatility. And now you can see how much Tesoro's average true range has come down. The stock is really quieted in its trading, and historically, when the range of Tesoro increases, Tesoro tends to go up, which is very much different from most stocks out there. Most stocks, as their average true range rises, they actually go down. With Tesoro and with Tesoro and some of the other refiners, it's a little bit reversed. Okay. All righty. Well, thanks for hopping on. Any questions, let us know. Carl will jump on with his top three. I'll jump on here near the end of the day, and we'll talk about some of the different trade setups that are out there. Max, good question. Do I look at the ticks to get a feel for some of the power behind a market move? I don't use it very much. Every day I look at the ticks and the trend and different things. Um, I kind of I would look at that much more as a day trader than as an option trader. But yeah, that's just preference. I mean, there's so many things out there that you can look at and so many different tools. All right. Well, thanks for hopping on. We'll talk to you soon. Take care.